You may have heard the word DeFi in the blockchain space, but what exactly is it? Well, DeFi stands for decentralized finance. Its goal is to recreate traditional financial services in a decentralized way using blockchain and smart contracts. For example, this allows peer-to-peer lending and borrowing without an intermediary on top of a transparent and trustless blockchain network. Unlike traditional centralized financial services, DeFi provides permissionless, open source, and censorship-resistant framework. Imagine taking a mortgage without needing a bank. The majority of DeFi projects are built on Ethereum, as it has the most developed ecosystem to write smart contracts. DeFi relies heavily on stablecoins like DAI, Tether, and USDC because it is impractical to create contracts for financial products and services in volatile currencies like Ether. Among the most common DeFi applications and use cases are lending, when users lend their cryptocurrencies and receive interest rate for it, which is currently distinctly higher than yield at traditional banks. Borrowing, when users borrow funds and pay credit interest on those funds in return. Trading cryptocurrencies on decentralized exchanges without a central entity and without forfeiting control over your coins. Trading derivatives like options, futures, synthetic assets, margin trading, and more. And some applications provide smart contract insurance for other DeFi protocols. Like with any financial instruments, there are some risks associated with DeFi. There are some technical risks like smart contract bugs, errors, and protocol changes. To mitigate these risks, for some protocols, users can get an insurance. As for the financial risk, most of today's DeFi platforms rely on the collateralization of assets, which means depositing your, for example, Ether in a smart contract to receive a loan in stablecoins. Lending protocols such as Compound or Aave use over-collateralization. This means you deposit, for example, $250 in Ether to receive $100 in stablecoin for a low interest rate. This addresses liquidity and credit risk and makes sure the loan does not get liquidated too easily when Ether price fluctuates. You may be thinking, wait a minute, is this just another hype or bubble? The hype around decentralized finance is not only noticeable in the sharp appreciation and value of DeFi-related cryptocurrencies, many of which being the biggest winners this year. One thing that meets the eye is that most of these projects were built during the 2018-2019 bear market and are heavily democratizing their governance. Today, over 6 billion euros are locked up in DeFi protocols, and many of these are generating millions of euros in annual revenues. Looking at actual DeFi users, the number is still relatively small at approximately 400,000 users, but it's growing exponentially. Many believe that DeFi finally meets the potential of programmable money and proves to be one of the most important new potentials of blockchain technology. DeFi could well be the technology digitizing banking, an industry that hasn't changed its infrastructure for decades. And this is what we have for you today. Let us know in the comments whether you think DeFi is just a hype or a long-lasting innovation. Are you one of the 400,000 users? What is your experience and how could it be better? Leave us any questions you might have about DeFi and we will make sure to answer it in our future videos. Please subscribe to our channel, leave this video a like if you found it informative and useful. Thank you so much for watching. Have a great week.